There is a very common idea out there, which is trying to retire off dividends or trying to retire off portfolio income. So dividends, interest income, etc. You'll see this all over the place, from Wall Street Journal to Forbes to books to YouTube videos. And I just want to talk about the idea a little bit and why I don't think it's the best idea, why it's somewhat suboptimal. My name is Scott Caulfield. I am a CPA and a CFA charter holder and the founder of Sophos Wealth Management. So let's look at some of the drawbacks of trying to use your portfolio income for retirement. Now, first of all, beginning dividend yields are really low today. And even combined with interest, which is better today than it was a few years ago, that's going to result in a pretty darn low beginning portfolio withdrawal. Few people can afford to retire on such a low withdrawal rate. Even if you could afford such a low withdrawal rate, it's going to be a suboptimal outcome. You're going to probably spend less than you otherwise could, and your portfolio is going to just grow into perpetuity. Maybe not the worst thing in the world, but you might be giving up opportunities to really enjoy your retirement along the way. If you don't go that route, you might kind of lead yourself to a suboptimal portfolio. A lot of people are optimizing for portfolio income rather than what's your risk tolerance, what are the investments that actually make the most sense, and trying to optimize for portfolio growth in your case. So you see some suboptimal portfolios put together in pursuit of greater income, plus portfolio income can go down. I mean, you look at 2002, 08, 09, that can really hurt your retirement. So let's break into these a little bit. Beginning dividend yields are very low today. In fact, the S&P 500 is currently around 1.3%. Now, that is pretty low historically. I mean, this chart going back to about the 1950s will show you it's often more around 3-4%, but today we're about 1.3%. If you combine that with, let's say, we're going to use the Bloomberg US Aggregate Index as our proxy for bond income, and that's at about 4.82%. So 4.82% is much higher than it's been in the last decade. Relative to a longer history, that's often been around, say, 5.5%. Even though this chart shows 4.6, that was at the end of January. If we combined the current dividend yield along with the current bond yield, and let's assume a 60-40 portfolio, which is pretty commonly seen, that would give you an initial spending rate of 2.7%. Now, you might be familiar with Bill Bangen's research on safe withdrawal rates. He said historically, over a 30-year time frame, a 4% withdrawal rate had never failed in U.S. history. And as that's been updated recently, more recent research, updated asset allocations, they've actually bumped that to more like 4.5%. Some would even say 5%. So I've got other videos talking about those withdrawal rates if that's what you're interested in. But 2.7 as the starting withdrawal rate today is very low, which leads to another problem. Very few people can actually afford to retire at only a 2.7% retirement or withdrawal rate. If you've got $1 million portfolio to begin with, you're only going to be able to draw $27,000 of income on that. For a lot of people, that is just not going to be enough to sustain their spending needs in retirement. So, there's a couple of my big problems up front with this. I just think that low withdrawal rate is very suboptimal, even if it does fund your spending needs. And this just kind of gets into what are you actually aspiring to in retirement. This kind of portfolio, if you're just living off portfolio income, you are going to grow quite a nice portfolio over time. You won't run out of money. When you pass away, you, in theory, should actually grow the portfolio quite a bit. However, for a lot of people, that's not the goal. A lot of people are trying to maximize their retirement, maximize their enjoyment, especially early in retirement, those go-go years when people are more physically capable of doing things they enjoy, things like golf, things like travel, all that kind of stuff. If you are just minimizing living off dividends and interest, you may not really be able to maximize that enjoyment. Additionally, a lot of people are moving towards giving more of their portfolio away during their life, whether that's to children, to charities. It's this whole die with zero concept. Not that I really want people to die with zero, but we don't want to just maybe optimize dying with the most possible. We want to optimize your sort of enjoyment and be intentional with your retirement and all that money you've worked hard to save. So I think that's another just big drawdown to this concept of only living off portfolio income. Another problem with focusing on portfolio income is that dividend and interest can go down over time. So I went ahead and went over to Portfolio Visualizer and plugged in a 60-40 portfolio. So this is like the Vanguard Total Stock Market Index and the Vanguard Total Bond Market Index. In this hypothetical, we assume somebody's retiring in 1998. They've got $1 million portfolio, and just to kind of make the numbers easy, I assumed a $40,000 initial withdrawal that would be adjusted for inflation. Now, what you can see in this chart here is the portfolio income over time. So if you look at it in 2001, it was up at 47,000. Well, by 2003, that portfolio income had dropped to roughly $28,000. So that is a substantial drop. And for a lot of people, that would be extremely problematic. I mean, you have to cut back massively, go back to work. I just don't think this is a very optimal setup. And again, you see this from 07 to 09, the portfolio income once again went down. So this is very problematic in my view. Now, granted, starting in 97, 98, maybe not the optimal time. You had a couple of good years, but then you had the 2000 to 02 market crash. You had 08, 09. So 2 crashes in there, which is pretty painful. But I think the important thing to look at is there are a few different times here where this portfolio has gone down and or portfolio income has gone down. That makes retirement planning on those kind of things rough, especially if inflation's going up and your portfolio income's down. That's just not good math. I think another problem here too is that a lot of people that are focused on dividend income or just portfolio income, they are setting their portfolios up to optimize for that income rather than optimizing for their actual risk tolerance, their goals, market conditions. And I always think back to when I was pretty early in the business. I started in 2010. Well, from 2012 to 2014, I remember I read Barron's every single Saturday. And almost every week, all year long, they would have headlines from all these advisors and other quote unquote experts who were pitching a lot of safe 5-6% yields. And one of their biggest recommendations, almost universally recommended, was MLPs because they gave tax advantaged income. And what is just, it didn't make any sense to me. You're trying to optimize for income. They did not look like great investments. Well, guess what happened? MLPs got absolutely obliterated following 2014. So, again, you look at some of these Barron's headlines, you had things like how to get 6%, how to get pipelines to pay out 6%. Now compare that to the Illyrian MLP. So the Illyrian ETF, it's just a bunch of MLPs. That thing went from $96 or so all the way down to, 16, 18. This thing lost over 80% of its value. Those relying on this income just absolutely got decimated. And again, the point isn't to focus on any one investment, but it's that a lot of people that are focused on this income tend to try to optimize just dividends, just interest income. And that may not make sense in your situation. That's going to lead to a suboptimal portfolio. I don't like to see portfolio income be kind of the thing that's driving your retirement. So I like seeing safe withdrawal rates. You can really just optimize your situation much more. What are current market conditions look like? How's your health status? How long of a retirement are we looking at? And that allows us to kind of focus on kind of the best portfolio for your situation. And also, how do we maximize your enjoyment of your finances and your enjoyment of your retirement so that you can retire with intentionality, so that you're doing things that support your goals. So anyways, I hope you found this video interesting and useful. I always appreciate when people like it. Subscribe to my channel and share with any people that you think might benefit from this. Thanks a lot.